Now, what does this mean for our portfolios? The $64,000 question. Well, if you look at this graph, this is the yield curve we see right now, starting 3 months right out up to 10 years. It's fairly steep. We think that over the next couple of years, it's going to get even steeper. And the reason for this is the Federal Reserve needs to steepen the yield curve because they want to get ready for raising short-term rates. And we think by 2016, you'll start to see that. In fact, most people estimate the U.S. Federal Reserve will start increasing rates in mid-2015. By the end of 2016, you could have short-term rates at around 2.25%. Now, to put that in perspective, a normalized environment, you'd have short-term rates at 4%. So we see rates going up, but nowhere near where they would be in a normal environment. So again, that slow unwinding of monetary policy. But what this means is if rates start to move up, you don't want to be like this guy with your investments. You don't want to be chasing yield because higher interest rates are going to put pressure on interest rate sensitive vehicles. So one of the things we're doing in our portfolios is we're trying to eliminate as much interest rate risk as we can and compensating to get a higher return with more credit risk. So with high yield bonds, we only have short-term bonds in our bond fund. We've supplemented that with some alternative managers that strip away even more interest rate risk and have a more levered play on credit risk. Mortgages, again, tend to have terms under 5 years, and we like the credit risk in mortgages. High yield bonds, again, they tend to have short terms. Now, and what happens if interest rates start moving up because the economy is getting better, high yield bonds benefit because the credit spreads tend to narrow. So they're a good vehicle in a moderately increasing interest rate environment. And then finally, preferred shares. There are different types of preferred shares. The ones you don't want are perpetuals because they have a long term, in fact, an infinite term. You want to have floating rate and rate reset prefers. And we've been trying to eliminate our perpetual exposure in our preferred share fund. Now, how about equities? How do they do in an increasing interest rate environment? Well, we look at this chart that shows the correlation between equity returns and interest rates, namely 10-year treasuries. You can see in this quadrant, you have a positive correlation. Interest rates go up, stocks go up. Whereas in this quadrant, you have a negative correlation. Interest rates go up, stocks go down. The key in this graph is the line here at 5%, because that's the dividing line between having a positive correlation and a negative correlation. Right now 10-year yields are 2.7%, so we're a long way away from that 5%. So even with a gradually rising interest rate environment, stocks should do fairly well. If we look a little bit deeper in the type of stocks that we're looking for, as we said, we like the US economy over the Canadian economy. You want to buy America. And what that means is buy American stocks, but also buy Canadian companies with exposure to America. Specifically, the housing market, not the Canadian housing market, the US housing market. Even though the housing market recovery in the US has stalled a little bit at the beginning of the year, we still think that this is an ongoing theme and a good place to be investing money over the medium term. Energy as well, with shale, oil, and gas is an area we like. You want to have exposure not only to the people that are finding the oil and gas, but the people that are building the infrastructure to bring it to market. And also industrials. They benefit from low energy prices for feedstock, as well as cheap electricity, as well as they benefit from the whole reshoring and build in America trend that we're seeing. And then finally, technology. If companies start to feel confident that the economy is increasing, they're going to invest more in their capital infrastructure. And technology is a big part of that. But the other thing, and I would say with all of these, that the valuation has to be correct. So if you indulge me, I'll use one last game show analogy. When we look at buying things, we won't buy anything unless the price is right. So in summary, it's a balancing act. It's a balancing act between door number 1 and door number 3. So the Fed has to navigate between those two doors. And what we think that means is that you'll get door number 2, but it's going to be not that easy. And what that means is a slow recovery for US employment with inflation remaining low. We think in Canada, you're going to have slower growth in the US, but still that increasing economic growth in the US is going to help the Canadian market. I think the 3 wild cards are going to increase volatility in the market. We're already seeing that. and I think it's going to continue throughout the year. It's not going to be like last year where the markets went up in a straight line. We still think you're going to see positive returns, but there's going to be a lot more volatility along the way. And then finally, equities over bonds. Now, David talked about a diversified portfolio. There's more to a portfolio than just equities and bonds, and John is going to go into a little bit more detail on that. So with that, I'm going to turn it over to John Nicola.